when you and I sat down to discuss topics impacting institutional investors today, SPAC, which is short for Special Purpose Acquisition Company, was on the top of our list. It seems like we cannot go through the daily news cycle without reading or hearing something about this topic. And in fact, I think I read something earlier this morning. So from prolific technology investors to celebrities to athletes raising these quote unquote blank check companies, can you describe to our audience what is a SPAC? And also, just more importantly, an overview of the life cycle of a SPAC from its inception through the consummation of a merger.
Sure. So I'll use this pictorial as a guiding diagram. At its core, a SPAC is a publicly listed vehicle that's used to bring privately held companies to the public markets. And typically, it starts out life as a blank check company that's organized by a sponsor that's then listed on a stock exchange. And really, the purpose of the SPAC is to acquire an as yet unidentified private company in a specific period of time, and that time frame is usually 24 months. So as you see on the top box here, the first step in the process is when a SPAC sponsor forms a SPAC itself. And, in turn for doing that, the sponsor's management team typically pays some nominal amount for an equity stake in the SPAC. That's called a promote, and it's usually 20% of the post-IPO value of the SPAC. And essentially what that is compensation for doing the work of identifying a target and then completing the reverse merger. The next step is when that sponsor begins the process of holding an IPO, which is kind of in the second line in this pictorial. They file an initial registration statement with the SEC. They raise capital from SPAC investors, which are on the middle left column here. And that's an area in which hedge funds in particular have been quite active, which I'm sure we'll discuss in a little bit. But in return for that capital, which is held in a trust until this target is identified, those SPAC investors get two things. They get common shares and they get warrants. And those shares are typically priced at $10 a share, and the warrants then provide additional upside. And both can be exercised, the warrants, I should say, can be exercised after the merger with the private company occurs. And I think what's important is both are freely tradable after the IPO. So that's when the SPAC has been set up. And then the next step is identifying a target private company to acquire. And, in this sense, this part of the process looks very much like a typical M&A transaction. The SPAC sponsor has typically 24 months to find their target. And after they find it, what's interesting is the SPAC shareholders have the option to redeem their shares if they don't like the investment. So effectively, if they don't like what they see, they can opt out of the transaction. Importantly, the acquisition targets are significantly larger than the capitalization of the SPAC that's acquiring them. And so there's oftentimes a simultaneous PIPE investment that occurs, which you see in the bottom left here. PIPEs are effectively public investments in private equity. And it's actually a critical part of the SPAC story, since the PIPE does a number of things. It guarantees the cash for the transaction. It also anchors the valuation in the public markets. And it can discourage SPAC investors from redeeming, which we just talked about. But the end result after all of this is you have a private company that now becomes a publicly traded company. And there's some lockup, typically about a year, when the sponsor can't trade their shares, but after that, they can be sold and provide liquidity to the sponsor. So many nuances to each step, but Cynthia, that's the life cycle in a nutshell.